What's going on, guys? MMuniz here. Welcome back to the channel. We've been seeing a consistent decline in the markets now for over 6 months. And to be honest, I don't believe we've reached the bottom yet. There are too many upcoming negative catalysts, such as more rate hikes from the Fed, possible recession, the list goes on and on. But with our long-term portfolios losing value on a daily basis, do we actually have options to make money in times like these? Well, that's what this video is going to be about. We're going to discuss inverse ETFs, what they are, how they work, who they're for, and my final opinions on actually using them. Now, with that being said, I do have to disclose that this video is not financial advice. It's just my opinion. It's up to you guys to do your own research and determine what's best for you and your family. That being said, I'm also going to give a too long didn't read or a too long didn't watch and say that inverse ETFs are not a good long-term investment. However, they do serve a purpose, and that's what we're going to talk about. So first things first, what exactly is an inverse ETF or a leveraged ETF? Well, to answer that, we have to describe what an ETF is. An ETF is an exchange-traded fund, basically a basket of stocks or securities that are traded on an exchange. They're very similar to mutual funds, and they typically follow an index, sector, or commodity. The prices of an ETF fluctuate throughout the day, same as any stock would, which is different from a mutual fund. The reason an ETF is good is it allows an investor to have a cheap form of diversification to their portfolio without them having to take the time to pick out their own stocks and rebalance. Basically, if you could put all your money into one company, you're going to have some risk if that company goes under. But you also have the possibility of a very lucrative reward. Maybe the business kills it. However, with an ETF, you have a basket of companies, a small piece of each company. And if one of those companies goes under, you're not going to lose your entire investment. You're not going to make as much, potentially, but at the end of the day, that diversification comes with a little bit less risk. I personally love ETFs. It is my own personal strategy for investing, long-term, buy and hold strategy where I dollar cost average in on a weekly basis. So an inverse ETF is typically an ETF that uses various derivatives, futures, contracts to profit from a decline in an underlying benchmark. So an investor is actually able to profit when markets are moving down. In a bear market or a recession, they'd be making money. Also, with inverse ETFs, you don't actually need to hold a margin account to short a stock or ETF, which is another option for making money in downward markets. So instead of doing shorts, you're just buying into a fund like you normally would, and they're handling all that for you. So making money in a bull market can be considered easy, but it is awesome. Making money in a bear market, a lot more rare, still just as awesome. Now, if you work hard for your money and you want to make it go further, make sure you smash the like button down below, subscribe to the channel. We do weekly videos on anything related to personal finance or fitness. Now back to inverse ETFs, let's take a look at an example. So if you hold an ETF like ARKK or ARK Invest from Cathie Woods, you have a lot of innovative growth companies, but these companies also tend to be higher risk. So when we're in a market like we are now, typically people like to be risk off. They're going to pull out of funds like ARK, which is why you can see here ARK is down significantly. In the past year, it's down 65%. Now there's an inverse ETF called SARK or SARK. It's called the Tuttle Capital Short Innovation ETF. SARK seeks to provide negative one time the daily return of the ARK ETF. So if ARK goes down 3% on Monday, SARK or SARK will actually go up 3% on Monday. Pretty cool. You can see an example of this here with ARK being down 65% year to date, and the short fund, SARK, being up 105%. So in a bear market like we're in currently, SARK, the inverse ETF, has actually been doing pretty well. So looking at inverse ETFs, it looks pretty easy. Well, the market's going down, we're going to make a ton of money. It's great. It's not that easy. So let's talk about the problems with inverse ETFs and leveraged ETFs. So problem number one just deals with how the market actually works and speculative risk. People invest in the stock market to make money. They believe that over time, their investment is going to return a profit to them. If they didn't, why would anybody invest? So betting in the opposite direction for anything longer than a short-term period just does not make sense at all. We know that using history, even with all the recessions, the dips, market corrections, the market is going to come back. So if you're hoping that the market declines forever and you're going to profit, the odds are just not in your favor. Plus, nobody likes that guy. Don't be that guy. It's like being at the casino, playing craps, and everyone's cheering, winning, having a great time, and you're the guy in the corner betting on 7, and then everyone loses all their money, and you're the guy that's winning his money. Not a good look. Nobody likes that guy. Now, I do understand if you want to be that guy because you think you're going to make money, that's fine. But just overall, the longer you invest in something, the chance of it going down, especially if it's like an ETF or something that rebalances, is just not that likely. Now, problem number 2. This deals with how inverse ETFs actually work. They're not long-term investments, as I said before. The fund managers actually buy and sell derivative contracts daily in order to meet the expectation of a negative 1x return. So over time, you actually won't have a negative 1x return based off the benchmark. Compounding returns can really amplify your losses. Yes, they can amplify gains, but they amplify losses, which is never a good thing. Basically, inverse ETFs and leverage ETFs are not always a direct correlation. So for a good example of this, we can look at the S&P 500, we can look at the ETF that's pretty common, which is SPY, SPY. We have the inverse ETF, which is going to be in the blue, and that's going to be SH. It's the ProShares Short S&P 500. So the reason I say that they're not correlated, this is a perfect example. If we look at the 1 year, we see that the inverse ETF is up 6%, but the SPY, or the actual ETF for the S&P 500, is down 11%. They're not one-to-one correlation. And the reason for that is in the beginning, the S&P 500 was still gaining, while doing the opposite, the inverse ETF was losing. Once the inverse ETF started making money because the S&P 500 was falling, the capital at the bottom here back in January was a lot less than the capital that they had at the beginning of the investment. Due to the fact that you lost money in the beginning, the gains that you were making at the beginning of this year were not enough to overcome what you lost already. So you're only up 6%, so it's not an exact correlation, and that's something we got to keep in mind. Now, looking at another example, the compounding returns, something from a leveraged ETF, is even more evident when we looked at something like TQQQ and QQQ. Both of these are popular ETFs. One of them is a lot more popular for day trading, which is the TQQ, or triple leveraged QQQ ETF. And the reason that I'm bringing these up is, once again, they don't have the exact correlation. So you see here that in 1 month, QQQ has lost 3.62%. However, in 1 month, the triple leveraged ETF, TQQQ, is down 14%, which is more than 3 times the actual return of the initial ETF. So at the end of the day, when you have a leveraged ETF like TQQQ, you think you're getting 3 times the returns, and on a daily basis you are, but when you multiply that out over days and days and months, it can be more. So you can amplify your gains, or you can amplify your losses, which is what I just showed. So let's talk about problem number 3 with these types of ETFs. Well, since they're managed daily by the fund managers, they're actively managed, which means they're going to have a higher expense ratio. Most of these inverse ETFs or leveraged ETFs are around 1% or higher when it comes to their expense ratio. That's significantly more expensive than even the income ETFs that we talk about a lot on my channel, like Q Yield or R Yield. So we know that these funds can be advantageous to certain people, but who exactly does that apply to? Who would benefit from buying inverse ETFs or leveraged ETFs? Definitely experienced day traders. I do not think that anyone that follows a passive investing strategy like me, where it's long-term, buying and holding, dollar cost averaging, I don't think that we're going to benefit from something like this. The reason is when you buy something like this, you need to realize that you may have to take a loss if whatever you speculated on becomes incorrect. If all of a sudden there's a catalyst that brings your fund in the wrong direction, you may need to sell. And honestly, I try not to panic sell. If you hold on to something like this for too long, you can easily see your investments just deteriorate over time. So lastly, what do I think about these ETFs personally? Well, when it comes to inverse ETFs, I've never purchased a single share of any inverse ETF. I have used leveraged ETFs. I typically use the fund TARK, which is a 2 times leveraged ETF of ARK, ARKK Invest by Cathie Woods. But I only use that to play around. You know, I try to be a day trader. Obviously, I'm not a professional. Honestly, I'm just trying to educate myself on all forms of investing. So if you're still watching this, I want you to comment down below with your thoughts on inverse ETFs and leveraged ETFs. Have you ever bought them? I do my best to respond to every comment on all of my videos. And with that said, I hope to see you guys in the next video. Take care.